Hello everyone, my name is Mihan and I am the founder of Tâm An Wealth and Health. Thank you for taking the time to join today's session. Today we will be talking about a very important financial topic that many people often overlook in their retirement planning, the cost of long-term care. Usually when we buy a car or a house, we get insurance to protect our assets. But very few people think about protecting their ability to care for themselves as they get age. The reality that 7 out of 10 people over age 65 will eventually need help with daily living activities, things like bathing, walking, or eating. According to Genworth's 2024 survey, the average cost of in-home care is about $68,000 per year, or nearly $5,700 a month. If you live in a nursing home with a private room, that cost jumps to over $115,000 per year, or roughly $9,600 per month. In California, those costs can be even higher. The most important thing to know is that most of these expenses are not covered by public programs like Medicare. So many people believe that Medicare will cover long-term care costs. In reality, Medicare only helps in very limited cases. For example, a short-term skilled care after a hospital stay for at least 3 days. If daily medical treatment is needed, and you transfer to a care facility within 30 days. Even when you qualify, the Medicare only pay 100% for the first 20 days. From day 21 to 100, you have to pay over $200 per day out of pocket. After day 100, the Medicare stops paying entirely. Medicare does not cover in-home care when you only need help with the daily activities like eating, bathing, dressing. And the Medicare does not cover for the long-term care in an assisted living facility. In other words, the kind of care that most seniors actually need is not covered by Medicare. So what happens if you don't plan ahead? I've seen families drain their savings, sell their homes, or depend entirely on their children. The good news is that we can start preparing right now. We no longer have to rely on outdated use it or lose it insurance plans. There are now modern, flexible solutions that help protect your family's finances, even if you never need to use long-term care services. Timing is everything. The earlier you plan while you're still healthy, the better. It's lower cost, more choices, and higher chance of approval. On the other hand, if you wait until you need care, it is a much more expensive and it's often too late to qualify for coverage. My role is to help you to understand your available options, compare different solutions, and work with you to build a plan that fits your family's financial situation and goals. As an independent insurance agent, I don't represent any specific company. I represent you and your best interests. My mission is clear: to protect the wealth you work hard a lifetime to build, to help you stay independent as you age, and to give you and your family peace of mind. At the end of the day, this is not just about health. It is about protecting your future, preserving your dignity, and honoring everything you work so hard for. So if you have any question during the presentation, feel free to leave in the comment section. I will answer them after the session. Now I will turn off my camera so that you can focus better, and let's begin the men's presentation. What is a long-term care? Long-term care means getting health with everyday activities when you are no longer able to do them on your own. These activities include bathing, getting dressed, eating, using the toilet, moving around, keeping clean, and taking care of personal hygiene. Most people think only older adults need a long-term care, but that is not always the case. We might need long-term care if we get seriously sick, having a disability, or are recovering from an accident even at younger age. Long-term care can happen in different places, at home with help from family members or professional caregivers, in assisted living facility where you can get help with daily needs, or in a nursing homes where nurses and caregivers are available 24/7. Understanding what long-term care involves and where you can receive it is a very important first step in planning for your future. Now, I would like to share with you the three most common types of long-term care insurance available today. Each one has its own strength, and understanding the differences can help you choose the best option for yourself and your family. First, asset-based long-term care. This type is also known as a hybrid policy because it combines two benefits in one contract. First, it provides the long-term care benefits. Second, it includes a death benefit for your beneficiary if you never end up using long-term care benefits. The premium is fixed and it won't increase every year. You can add an inflation protection rider, which means your benefit amount will grow each year to help keep up with raising care costs. Example, let's say you purchase a policy that gives you $3,000 a month in care benefits. If you add a 5% annual inflation rider, after 10 years, your monthly benefits will grow to almost $5,000 a month. Second type is life insurance with long-term care rider. This is a regular life insurance policy, but with an added option. If you need care, you can use part of death benefit early to pay for the long-term care expenses. Flexible premium, you can adjust based on your income. The death benefits is often higher than asset-based long-term care. However, if you use the long-term care benefits, the amount left to your loved one will be reduced. And not all policies offer the inflation protection as an option. Third type is annuity with the long-term care benefits. Annuity combined with the long-term care coverage. An annuity is simply a contract that turns your savings into a steady stream of monthly income, which can last for many years or even lifetime. When you add long-term care benefits to an annuity, your income may double if you need long-term care later in life. For example, if you invest $200,000 into an annuity policy, and you will receive around $30,000 to $40,000 per year. But if you need a long-term care, your contract may pay up to $60,000 or $80,000 per year for 5 years. No medical exam required. Just answer a few simple health questions. If you don't end up needing care, your money still grows. However, the double benefit depends on how much is left in the contract at that time. So if you've been withdrawing your income from an annuity for 15, 20 years, the remaining balance may not be enough to activate the full long-term care benefit. That is why if you're planning to use an annuity for long-term care, it is best to set it aside and avoid early withdrawals so the benefits is fully available when you need it. So which one should I choose? Personally, I often recommend asset-based long-term care because of its high flexibility. If you don't use the care benefit, your loved ones still receive the death benefit. If you do need care, you might receive $300,000 to $600,000 even if you only invested $100,000. If you change your mind, you can still get your money back. In short, one contract covers three needs: money for care if needed, money for your family if not needed, option to take the money back if plans change. Long-term care is a real need, and the sooner you prepare, the less stressful it will be later on. By understanding each option clearly, you can take control of your financial planning and bring peace of mind to your entire family. Let's take a look at the two main ways long-term care insurance can pay out benefits to you or your loved one. Let's take a look at the two main ways long-term care insurance can pay out benefits to you or your loved one. First, reimbursement, pay based on receipts. The insurance company will reimburse you for your long-term care expenses as long as you provide valid receipts. However, there is something important to keep in mind. The caregiver must be a licensed professional. For example, you cannot pay your daughter to cook and then submit the receipt for the insurance company unless your daughter is a licensed professional. Some policy may offer the lifetime benefits, meaning there is no limit to the number of years benefits can be paid. Second type is indemnity. This option is much simpler. Once you qualify for benefits, the insurance company will pay you a fixed amount every month, regardless of how much you actually spend. No receipts required. You have complete control over how to use the money. You can hire an in-home care, move into an assisted living facility, or even have a family member help you. It also makes easier for families to plan care based on your unique situation, including health and financial needs. Understanding the difference between these two payouts will help you choose the option that best fits your long-term care plan, giving you both financial security and flexibility as your needs change. When choosing a long-term care plan, it is important not only to look at how much the policy will pay, but also to carefully consider how it works and whether it fits your lifestyle. Here are three key factors you should keep in mind. First, choose the right benefit payout method, indemnity or reimbursement. If you choose indemnity, you will receive fixed monthly benefits and no receipts are required. The advantage is flexibility. You can use the money however you need, whether it is to hire in-home care, move to assisted living facility, or get help from a family member. With reimbursement, the insurance company only pays you back after you submit a valid receipt. This option often comes with the lower premium. So if you value flexibilities and fewer restrictions, indemnity may be the better choice for you. Second, does the policy cover care with living abroad? Many people plan to retire overseas or travel for extended periods. Some long-term care policies do not pay if you're receiving care outside the US. Others offer international coverage, but with limited benefits. So if you plan to leave or travel abroad during retirement, make sure your policy includes international care coverage. Third type, premium payout option, short-term or lifetimes. Some policies allow you to pay all at once or spread payment over 5, 10, or 20 years. Others may require you pay for the rest of your life. To receive benefit from long-term care insurance policy, you must meet 4 important conditions. Many people are not fully prepared for these, so I want to clearly explain them so you and your family can plan ahead with confidence. First, medical certification. A licensed doctor or nurse must certify that you are chronically ill. There are 2 situations where you might qualify. You are unable to perform at least 2 out of 6 basic daily living activities, such as bathing, dressing, eating, using the toilet, moving around, controlling bladder or bowel. Or you have severe cognitive impairments, such as Alzheimer or dementia, and need ongoing supervision for your safety. Second requirement is a written plan of care. You must have formal care plan written, which outline what kind of care you need, who will provide the care, where the care will take place at home, in an assisted living facility, or in a nursing home. For example, in-home care 3 times a week to assist it with bathing and meals. Elimination period. This is a waiting period before benefits begin, similar to deductible in health insurance. So typically, it is 90 days from the time care starts until the insurance company begin paying. This means even if you start receiving care on day 1, the insurer won't pay until the elimination period is over. Fourth requirement, activity policy. Your policy must be active and in good standing with all premium paid. If the policy was canceled due to missed payments, or even if you meet the medical requirements, you won't be eligible to receive benefits. Lastly, your policy must be active and in good standing with all premiums paid. If the policy was canceled due to missed payments, and even if you meet all medical requirements, you won't be eligible to receive benefits. Understanding and preparing for these 4 requirements will ensure you and your family receive a benefits on time and as promised when you need them the most. Let's take a closer look at the 6 basic activities of daily living that each person typically needs to do in order to care for themselves. Long-term care insurance uses these activities of daily living to determine when someone qualifies for benefits. If you are unable to perform at least 2 out of 6 activities on your own, or if you have cognitive condition such as Alzheimer or dementia, the policy will usually begin covering care costs. Here are 6 key daily activities to remember. First, bathing. Being able to safely bathe yourself in the shower or the bathtub, including getting in and out without assistance. Second, dressing. Being able to dress and undress yourself, including tasks like handling button, zipper, and medical device such as braces. Third, eating. Being able to feed yourself once meals have been prepared and placed in front of you. Fourth, toileting. Fourth, toileting. Being able to get to and from the toilet independently and manage bladder and bowel control. Fifth, mobility, 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 mobility.
Bowel control, mobility.
Mobility. Fifth, mobility inside the house. Being able to move around from one room to another in a flat surface. Fifth, mobility. Being able to move around from one room to another on a flat surface. Six, transferring. Being able to move in and out of a bed, chair, or wheelchair without help. These are main factors that insurance companies evaluate when determining long-term care benefits eligibility. Understand them early can help you and your family better understand. These are the main factors that insurance companies evaluate when determining long-term care benefit eligibility. Understanding them early can help you and your family better prepare and plan for the future. When it comes to long-term care insurance, there is an important part that you should all pay attention to: the elimination period, or waiting period before benefits begin. So what is an elimination period? When it comes to long-term care insurance, there is an important part that you should all pay attention to: the elimination period, or waiting period before benefits begin. What is an elimination period? The elimination period is the time during which you must pay for your own care cost, usually 90 days, before the insurance company starts paying your benefits. The elimination period is the time during which you must pay for your own care cost, usually 90 days, before the insurance company starts paying your benefits. Instead of paying a certain dollar amount, like in health insurance, you wait a set number of days. It's like a deductible in time. Instead of paying a certain dollar amount, like in health insurance, you pay a set number of days. Why does this waiting period exist? The reason is that insurance companies want to filter out short-term care situations, like needing help for just a few days after the surgery. The elimination periods ensures that benefits are only paid in case of true long-term care needs. Good news. Some insurance companies offer retroactive payment during the elimination period. That means when you complete 90 days waiting periods, the company may reimburse you for the care you receive during those first 3 months. There are two common types of retroactive payment. First, calendar-based retroactive payment. You must complete 90 days waiting period. After that, the insurance will pay you back for the full 90 days of care. No need to submit the receipts. It pays as cash benefits, indemnity style. Payment is often made as a lump sum. Second type, up to X months retroactive payment. You still have to complete 90 days elimination period, but the policy allows reimbursement for up to 3 months of care received before official benefits begin. The way it calculated can be more flexible, but it is also depends on the contract wording. For example, if you only receive care for a few days a month, you might not qualify for full reimbursement. Why it is important. Knowing whether your policy offers retroactive payment helps you prepare financially for the first 3 months. Avoid surprises when benefits don't kick in right away. Understand how your policy works so you can plan better care for yourself and your loved one. So when you're exploring long-term care insurance, don't overlook the elimination period and its reimbursement rules. They can make a big difference in your overall experience and your finances when the time comes to use your benefits. To help you better understand how calendar-based retroactive payment works in long-term care insurance, here is a practical example with a specific number. Let's say Mary starts receive in-home care on January 1st. Her long-term care insurance policy has a 90 days elimination period, meaning the insurance company won't pay any benefits from January 1st to March 31st. Her policy provides a $10,000 monthly benefits. On April 1st, once the 90 days waiting period is completed, the insurance company issues a one-time lump sum payment of $40,000. This includes $10,000 for January, $10,000 for February, $10,000 for March, and $10,000 for April. This is what is called a retroactive payment. Starting in May, Mary will continue to receive $10,000 per month for as long as she still needs care and meets the policy requirements. If the policy is set up as cash indemnity plan, Mary does not need to submit the receipts as long as she meets the medical requirements and completes the elimination period, and she will receive the payment. This type of policy helps family manage care costs right from the beginning, avoiding financial gaps during the critical early months of care. Let's walk through a practical example with real numbers. Let's say John begins receiving long-term care on January 1st and continue receive care consistently through March 31st. His policy includes 90 days elimination periods, which runs from January 1st to March 31st. During this time, the insurance company does not pay any benefits. On April 1st, once the waiting period ends, John officially qualified to receive long-term care benefits. Here is what usually happens under up to X months retroactive payment model. On April 1st, Johns received $10,000, the benefits for the month of April. The insurance company then reviewed his care records for the period 3 months, January, February, and March. If he qualifies, they might reimburse up to $30,000 for those months, but the payments are issued separately, not as a single lump sum. Many policies that use this method only state that they will reimburse up to 3 months of care, but they don't guarantee all 90 days will be covered or whether it will be paid in one lump sum or in separate payments. That is why it is important to clarify with your insurance provider. Will they cover the full 90 days of care? Are there minimum care requirements for each month to qualify? Or will retroactive payment be made all at once or in monthly installments? This type of payment can still help cover the cost of care during the elimination period, but the payment method, lump sum or monthly, the exact amount reimbursed. This type of payment can still help cover the cost of care during the elimination period, but the payment method, the exact amount reimbursed, and the certainty of receiving full benefits can differ from the more straightforward calendar-based retroactive payment, often more predictable and simple. That is why understanding your contract details is essential, so you can avoid surprises and plan your finances confidently from the beginning. When it comes to asset-based long-term care insurance, there is a valuable tax benefit that many people often overlook. So when you purchase an asset-based long-term care policy, the premium you pay is usually made up of two parts. First, life insurance portion. Second, long-term care portion. Long-term care portion includes the base long-term care benefits, any extension of benefits if needed, and an inflation protection rider if you choose to include it. Which part may have tax advantages? It is the long-term care portion of the premium. This part may be tax deductible depending on your situation. If you have health savings account HSA, you may also be able to use HSA funds to pay for this long-term care portion. Keep in mind, the amount you can deduct depends on your age, and the limits are updated annually by the IRS. The older you are, the higher your deductible limit can be. So this is a great tax saving opportunity, especially for people approaching retirement or looking to use their HSA in a smart and efficient way. When you apply for long-term care insurance, your application goes through a process called underwriting. This is the step where the insurance company evaluates your overall health to decide whether you qualify for coverage. So how does the underwriting process work? First, you will complete the health questionnaire. It typically includes questions about your medical history, your current health status, any past surgeries, and the medications you are currently taking. Next is usually a phone interview. If you are 60 or older, this call may include a few short memory and cognitive questions. The insurance company may also request medical records from your doctor or clinic to get a clearer picture of your health. They will also review your prescription history to verify what medications you are taking, how often, and for what conditions. Once all information is gathered, you will typically receive a decision within 2 to 4 weeks, possibly sooner if your application is straightforward. A quick reminder, it is best to apply while you're still in good health. A quick reminder, it is best to apply while you're still in good health. You are more likely to be approved and you will have more policy options to choose from and most importantly, your premium may be much lower. If you wait too long and develop health issues, you could face higher premium, reduced benefits, or may even be denied coverage altogether. So taking action early ensure you have access to the best option and a peace of mind for the future. Today, I would like to share with you how I typically work with the clients when planning for long-term care. I always follow a simple, clear, and easy to understand process. My goal is to help you fully understand your options, choose the right solution, and know that I will be with you every step of the way. Step number one, understanding your situation. Step number one, understanding your situation and needs. We will begin with a relaxed, friendly conversation. I will ask you a few questions such as how old are you? How is your health? Who are you planning to protect with this coverage? Yourself, your spouse, or your parents? What does your retirement plan look like? Do you really have any insurance coverage? What is your budget? So these questions help me recommend a situation that truly fits your personal situation and financial goals. Step number 2, explaining options clearly. What you are hearing today is part of step 2. I will walk you through what Medicare covers, what it doesn't, a comparison of long-term care options such as asset-based contracts, life insurance with the long-term care rider, or annuity-based care plans. I will also explain the potential tax advantage of choosing the right type of policy. Step number 3, showing customized illustrations. Based on your age and health, I will prepare easy to understand example with real numbers so that you can clearly see how your benefits grow each year if you add an inflation rider, how starting early can lead to significantly higher benefits, what happens if your death benefit if you never end up using the long-term care coverage. Step number 4, choosing a funding option that fits. Together, we will decide on payment method that works best for your finances, such as a one-time lump sum, spreading payment over 5, 10, or 20 years, or paying until age 65. I will also help you explore optional features such as return of premium if benefits are never used, inflation protection to keep up with raising care costs. Step number 5, full application support. I will assist you with everything from completing the application to organizing paperwork or even preparing for your health questions. If a phone interview is needed, I will walk you through in advance so that you feel confident. I will also work directly with the insurance company to make sure the process goes as smoothly and quickly as possible. Step number 6, ongoing support for you and for your family. Even if after your policy is approved, I will be here whenever you need help. If you or a loved one ever need to file a claim, I will personally guide you through each step so you are never left to handle it alone. With this approach, I aim to make long-term care planning less overwhelming and more empowering, so you and your family feel protected and confident for the future. Thank you for taking the time to listen today. I hope this insight help you better understand long-term care planning and how it can protect your future and finances. If you have any question, feel free to email, text, or call me directly. If you're ready to apply for long-term care insurance, I am here to guide you every step of the way. If you have any questions, feel free to email, text, or call me directly. Reach out anytime. I am always happy to help.